Hey guys, it's Brian. Welcome to Financial Fitness. If you're new to the channel, please subscribe. In this video, I'm going to talk about 7 steps to take to get off the sidelines and invest if you're sitting on cash. Let's get started. People have many different reasons for staying out of the market. Most of the time, they don't know what to do, so they put it off, or they're scared they'll make the wrong choice and default to not investing at all. Some other reasons could be that there was a point where you sold out of your investments to pay for something and never got around to getting back into the market, or you just hold on to a little extra cash as a habit and in case of an emergency. Maybe you've been building up cash in an IRA or brokerage account, but you still haven't picked investments. Or maybe you're nervous about investing outside of your 401k or employer-sponsored retirement plan, or you just don't know when the right time is to get reinvested. Whatever reason you might have, it's not too late to start investing and to start growing your nest egg and portfolio. Here are some steps to get you into the market and off the sidelines. Step 1. Don't focus on the past or what held you back from investing. It's possible you might feel compelled to research just about every possible investment in the hopes of picking a couple winners. There is no singular right investment choice. It's more important to just start or restart investing. Focus on building a solid portfolio by diversifying your investment mix with or without the help of a financial advisor or robo-advisor. Spread the amount you have available to invest across different indexes and industries. If that sounds confusing, you can invest in one index which covers different industries like VOO or a professionally managed account. You can also watch my video on how to invest $1,000 for more details on exactly how to get started and pick the right type of account for your financial situation. Step 2. Focus on the future. You can't benefit from any of the gains in the past, but once you get started or started again with investing, you have a chance to achieve some gains and profits from the stock market. Historically, the stock market has risen over the long term, and being invested has provided better growth than just staying in cash. Cash can be beneficial during the market downturns to potentially buy the dip, and if you need money to pay for something specific like a home renovation or an emergency of some kind. A diversified investment portfolio that is suitable based on your risk tolerance, financial goals, and overall financial plan give you the best chance to achieve your financial goals and take advantage of the gains in the stock market. Step 3. Decide if you need to get help to build and maintain your portfolio, or if you can manage it on your own. Putting money into the stock market can make anyone new to investing nervous. If you're in that situation, consult a financial advisor to help you build a portfolio or a financial plan in addition to your portfolio. It doesn't hurt to ask for help if you truly need it to start investing and don't know where to start. Though I do think that at some point in time after you've started to learn enough about the stock market and what it takes to build and manage a portfolio, it could be best to revert back to managing your own investments, unless the fee is reasonable and the performance is around or above your expectations, or you simply just don't have the time to manage it yourself. I've said this before in a past video, but no one cares about your money more than you do. Step 4. Figure out your risk tolerance and financial goals. Building a portfolio can be intimidating, but breaking it into a few steps should make it easier to get started. The first step is to figure out what your financial goals are and when you want to achieve them. I have a video on setting and achieving your financial goals to help you understand how to define them for yourself. The second is how much risk can you tolerate, meaning how much can an investment rise or fall that you would accept without it impacting your financial situation or losing sleep over. The longer your time horizon, typically the more risk you can reasonably take on. There are several risk tolerance quizzes that you can search for to help you determine a guideline for yourself. If you work with a financial advisor, they should give you a questionnaire to help assess this before building your portfolio. Step 5. Consider your investment mix and which investments are suitable for you. Your investment mix or asset allocation largely depends on your risk tolerance. Asset allocation is your overall mix of stocks, bonds, cash, and other investments. Typically, a higher risk tolerance should allow you to have more money in investments with higher risk and higher return potential, like stocks or alternative investments. You'll need to figure out if mutual funds, exchange-traded funds or ETFs, individual stocks, bonds, or alternative investments like real estate, which of these might work best for you. When diversifying, try to invest in different sectors and investment types. It's possible to feel like you might be overwhelmed with the amount of investment options, but focus on building a diversified portfolio either on your own or with some help from a financial advisor instead of trying to pick a few hot stocks yourself. You can also watch my video on how to invest $1,000 for details on the various investment sectors. If you want to keep things simple and somewhat safe, go with a low-cost ETF that tracks the S&P 500 like VOO, which would be only one investment choice and strategy. Step 6. How much and how frequently can you invest? Once you have an idea of what your portfolio will be invested in, you'll have 2 to 3 choices on how to fund your investments. Buy in all at once with one or more big trades, buy in all at once periodically, save up a lump sum, and periodically buy in with one or more big trades. Buy in gradually over time with consistent, smaller purchases that ease you into the market, also known as dollar cost averaging. Each approach has its pros and cons, but historically investing a lump sum all at once has usually beaten dollar cost averaging, though dollar cost averaging might be the more affordable and automated approach. With dollar cost averaging, you can set a specific dollar amount to be withdrawn from your bank account every month or week and set that to purchase the investment allocation or investments that you've chosen. This allows you to save and invest money without having to think about it all the time. Step 7. Don't worry about the timing, just get invested. Once you've completed the previous steps, it comes down to when you would actually execute those investment choices you've made. Don't worry about whether today is better or if next week you think the market is going to drop. Focus on just getting invested, since long-term investing is less about the exact timing and more about how long you've been in the market to give your investments a chance to grow. Missing out on only a few days of market gains can make a big difference to your portfolio's long-term performance. Investing during bad times in the market has historically provided some of the best subsequent returns. To summarize, whether you're new to investing, have some extra cash suddenly, or you've been sitting in cash for years, it's not too late to grow your money. Try not to regret missed gains, find the perfect investment, or pick the perfect time to buy in. Focus on creating a diverse investment portfolio that works for your risk tolerance and financial plan. Step 1. Don't focus on the past or what held you back from investing. Step 2. Focus on the future. Step 3. Decide if you need to get help to build or maintain your portfolio or if you can manage it on your own. Step 4. Figure out your risk tolerance and financial goals. Step 5. Consider your investment mix and which investments are suitable for you. Step 6. How much and how frequently can you invest? Step 7. Don't worry about the timing, just get invested. Thanks so much for watching. I hope you liked this video and found it insightful. Click the like button if you did, and please subscribe if you haven't already. Click the notification bell so you can see when I post videos next. Feel free to leave comments, questions, and any topics you might want to hear about in future videos to get on track to being financially fit. See you in the next video.